Welcome to another video. Today I will be sharing with you exactly how you're supposed to be reading the order flow of hedge funds in the market. So the commitment of traders. Now, if you don't know what that is the positioning of the biggest speculators in the market. So basically the sum of all their long positions and short positions in the market. And if you are able to understand how they are trading the market, you can follow them, okay? Following the big boys in the market. And basically you will have an edge over your competitors. So I suggest you watch the video until the end because it will be filled with value. Now, if you're new to the channel, I'm a top author on the TradingView platform and I share free education and analysis on all my platforms. So I suggest you subscribe and I will see you in the video. Okay, so today we will be speaking about a very important topic. I got asked about making this video many times, so here it is. Today we will be speaking about how you're supposed to be reading the COT data, so the commitment of traders, what hedge funds are doing in the market. Now you all have access to this information. Now specifically this app that we have here that automatically collects the data, this is accessible from the student dashboard, so it's part of the mentorship program, but you all have access to this data already, okay? You only have to know where to get it and how to build it, but it's data that is there for you on the internet to get. But you have to know how to relate it to the chart. Having the data alone means nothing if you don't know how to read it and, most importantly, relate it to what is going on in the market. And that is exactly what we will be speaking about in this video and why I am making it. Now, if you have watched my analysis in the past, I publish a lot of analysis, and if you haven't, by the way, I suggest you go and check it out on my YouTube channel, TradingView, and all my platforms. You will have noticed that I use this a lot. And why do I use it a lot? Because if you have informations on what hedge funds are doing because they're forced to report their positions, you can be trading with them if you know how to read it and most importantly, how to relate it to what is going on in the market. So from a price action perspective. Now, hedge funds are winning most of the times. So if you can trade with them, you definitely have an advantage over your competitors in the market. Just a quick reminder, make sure you comment below and you let me know which pairs topic you would like me to cover in the next video. Before I go straight into explaining the different kind of situations that in my experience are the best in relating COT data and price action, for example, I want to show you how we predicted this move to the upside on Euro GBP. Now, trading is not predictive, trading is reactive, but we were looking for the possibility to be reactive, in this case, from an entry perspective after this distribution to the downside for the move to the upside. And if you remember, we spoke about this possible bearish trend developing on the pound many times. I will publish all those links in the description of this video and you can go and watch those analysis before this move happened so that you can basically understand how, again, using price action and COT data is very effective. And we were able with students to bank both on the move to the upside on a Euro GBP and also on the move to the downside on GBP CHF. Obviously, they are correlated. But let's speak, and we're speaking about 1 to 3, 1 to 4 risk to reward on these moves. But let's speak about which are the best ways to relate COT data and price action. So these are the scenarios that are the best. If you have a market that is moving to the upside, so you have a bullish trend developing in the market, and during the move to the upside, you see from an order flow perspective, hedge funds closing their long positions, but not adding shorts, okay? So move to the upside, they're closing their longs, but they're not adding shorts yet. What will happen is that after the market makes the move to the upside, the market will start a distribution area in which they will actually start adding their shorts, and then the market will make the move to the downside. So If you see hedge funds during a move to the upside in a market, in a certain pair, doesn't really matter which one it is, you see them close their longs but not add shorts yet, expect a distribution, so basically a consolidation area with a lot of rejections. In there is where you have to be looking for your short, according obviously the rules of your own strategy, because very soon the market will start a move to the downside. Another scenario, the market is trending to the downside. Hedge funds, you see them close shorts, so minus thousands of positions, but they're not adding longs yet. What do you expect? You expect in this case, you expect an accumulation area, so an accumulation pattern, a lot of rejections, a clear deceleration, because inside of this pattern, they will be adding their long positions. So you have to be looking for potential longs inside of this area according the rules of your own strategy. And that is exactly what we had here on Euro GBP. Okay, we wanted to see inside of this area, hedge funds add shorts on the pound, which is exactly, if you remember, what we were seeing. We were seeing them basically add short positions from a GBP perspective, thousands of short positions added. Look at how many short positions added, thousands of short positions added from an institutional perspective. So you expect shorts on the GBP, so bullish Euro GBP, and you want to see the market then make the move to the upside. So these are two scenarios in which the market is trending in one direction, hedge funds close their positions in one side but don't open the trades yet. So you expect an accumulation or distribution pattern before the market moves in the opposite direction. And this is what we had. Now, what happens if during a move to the upside? So let's go back here. The market is moving to the upside. Hedge funds are closing longs and opening already shorts. So here they weren't opening shorts yet. Here they are closing longs as here, but they are already opening shorts. In this case, you expect a shift that will be very fast. So you can already be looking for shorts if on the 4 hour your rules for entry will be satisfied. As soon as your rules for entry in this case are satisfied, I suggest you immediately enter, because the market will change direction very quickly because they are loading up their short positions already during the move to the upside. And same thing if the market is moving down. If in a bearish trending market, hedge funds are closing their shorts and adding longs, expect a quick inversion to the opposite side. So be ready from a 4 hour perspective to monitor price action according to the rules of your own strategy. Obviously, with students, we have our own rules for entry. And as soon as the market satisfies your rules, be ready to enter, because the market will quickly change direction. Now, again, another situation that can happen in the market. In a trending market, okay, the market makes an impulse. As you know, the market moves in impulses, right? Impulse and correction, impulse, correction, impulse, correction. The most common pattern in the market, so creating lower lows and lower highs. Let's speak in specific about these impulses and corrections. If you have a market that is moving to the downside, so makes an impulse to the downside, makes a correction, and after the impulse, during the correction, hedge funds are adding longs, but not closing their shorts. So you have a market that is impulsing to the downside, starts a correction, hedge funds are longing, but they're not closing their shorts. If they are longing, they're just longing to show this correction, make many retail traders buy so that they can use their liquidity to actually open more shorts and continue with the move to the downside. Okay, that is what they're doing. They just want to make people buy so that they can continue to ride their sell orders, because as you know, they need to generate the liquidity to actually trade, because there isn't enough liquidity for them to just trade the market. They have to generate it. And how do they generate liquidity? To add more shorts, they just long a little bit so that people start to buy, and at that point they sell again, and they use your money to actually sell again. So if you, during a trending market, they don't close their shorts, during a bearish trending market, during a pullback, they open longs but they don't close their shorts, expect continuation to the downside. On the other side, if during a bearish trending market, they close their shorts, but they add longs, is back to the situation here. You want to see an inversion of the trend, okay? Very simple concept. Now, if during a bullish trending market, after an impulse and the correction starts and hedge funds start to open shorts but not closing their longs, what do you expect? Same situation as before. You expect the continuation to the upside. On the other side, if they are closing their if they're closing their longs and opening shorts, then obviously you expect an inversion of the trend and continuation of the downside to the downside. So these are some very basic concepts when it comes to reading the COT data and applying it to what you have from a price action perspective that definitely all of you should know. Now, I try to go to explain as much as possible in this video. Obviously, following my analysis every day on all my platforms will help you understand better how to apply what you have from a COT perspective to the chart, but obviously the next level is then achieved in the mentorship program, because my strategies are most effective if everything is done according to our rules, because that is what is tested and what it works best for. Because all the strategies that we trade are tested for at least 5 years in the past, plus live tested for at least 1 year before they get ever shared with members. And that is what you're supposed to be doing as well. If you want to develop your own strategy, you have to test it at least 5 years in the past, at least 6 months in live trading to prove it profitable, and then you can put some real money into it, real capital into it, and the more you put, the more you make, because in the end, it's just a game of percentage. If you enjoyed the video, make sure you smash that like button and comment below. It really does support the creation of more free content on all my platforms, as well as going and checking out the mentorship program. You find the link in the description. It's a very complete program. You first learn all the rules of my strategies, and then you trade them live with me. Each and every day, I give you a new daily market breakdown showing you how to apply the strategies with entry, stops, and take profits, as well as answering every question that you have each and every day. So you can click the link and go and check it out, or I will see you in the next video.